Our discussion with Kroll's corporate finance and valuation experts Carla Nunes and Bob Bartell looks at the current climate.
It is getting tougher and tougher to really predict what's going to happen in the future and to have reasonable financial projections. It doesn't look like there is anything that is going to sort of turn in the next 3 to 6 months.
Bob and Carla tackle the big issues, those economic concerns in an uncertain election year with increased global disruptions. While major central banks may cut interest rates later in 2024, it may not be as soon as investors hoped.
Investors, I think, are now coming to the realization that central bank actions, and particularly the Fed in the United States, are going to keep interest rates higher for longer. And that was not fully priced in markets. They thought that at one point the Fed would start decreasing interest rates, which would sort of decrease the cost of capital that companies are facing. We're not at that point at this juncture. We're really at a point where the Fed has multiple times said they're going to keep higher interest rates for a longer period of time in order to control inflation, which has been coming down nicely, but it's still stubbornly high compared to the 2% target the Fed has. So, while interest rate cuts are expected later in the year, long-term rates are still much higher than during COVID, and in fact, are much closer to where they were during the 2008 global financial crisis.
Starting in the late fourth quarter 2022, it was clear the transaction activity was slowing. But then in January, February, a lot of investors, a lot of private equity managers, M&A bankers had a little bit of wishful thinking in that by the second half of 2023, rates would be coming down, leverage would be back to 2021 levels, and it's apparent it hasn't happened.
Markets may experience a roller coaster ride in the next few months.
Interest rates are high. Inflation is still something we're all challenged by, with energy prices and food in particular. But also the cost to own a home, the cost to rent an apartment have skyrocketed. Markets are still uncertain and kind of just in a timeout right now.
To Bob's point, uncertainty is really the name of the game. Will this stay on? Big question mark. There's still a lot of factors that are creating demand for labor. So the labor market is still very tight. There is the Infrastructure Act, and there is the Inflation Reduction Act, and both of them require a lot of demand for labor. Wages are still on the rise. Inflation is still potentially going to be difficult to come down, even on the wage side of things. So those are other elements that the Fed needs to deal with in deciding whether interest rates need to stay there higher for longer.
What will the impact be on cost of capital?
From a cost of capital standpoint, what we can expect is risk-free rates to continue to be higher for the foreseeable future.
What does this mean for company and fund valuations?
Unless earnings improve significantly, we're looking at a higher cost of capital means lower values, if you will.
Companies are still trying to be creative with joint ventures and even mergers. It may not create a cash out opportunity today, but whether you're a public company and you're expected to deliver double-digit growth, or a private equity owned business, growth is the name of the game, and facing slow growth, anemic growth, corporations are going to look to creative alternatives to create shareholder value.
As our discussions with Bob and Carla continue, learn more about how Kroll drives results and confidence.
I'm Carla.
And I'm Bob.
And we help clients stay ahead with Kroll.